All right, let's take another caller. Miriam in Calgary, go ahead.
Good evening, David. I'd appreciate your views on CCL. I've followed it for quite a little while, bought some, sold it too early, and wondering if it's stalling now or if it's a good time to get in again. And Catherine, could you give me the consensus? I appreciate the numbers, not the proportion. Thank you very much. Bye-bye.
So, Miriam, the CCL is a great company. It is, at times, a more defensive play. And so if we are into a world of sort of a more cyclical environment where industrials are leading and technology and financials, it may underperform a little bit. They have done a wonderful job of building this business, right? I mean, it's been a very, very strong business. In the short run, though, again, this may be one of those companies that could be a little bit of a source of funds. And so I'd be a little bit careful. This is a company that we've owned over time. We don't own it currently because we moved a little bit away from things that were more like consumer staples and consumer non-durables.
Okay. And the average price on the stock is $283. In terms of the range, it looks as though 275 is on the lower side, that's with Macquarie, and then 307 is on the higher side, that's with GMP. So 275 up to 307. Let's take another caller right now. Natalie in Guelph, go ahead.
Thank you for taking my call, Mr. Burrows. It's such a pleasure to listen to your comments. When you made your original comment at the beginning of the show, you mentioned different sectors. However, you didn't mention healthcare. I'm currently holding Walgreens. I purchased it about a year and a half ago at 88. It's going nowhere. What should I do? Should I continue to hold or should I just let it go? Thank you very much for your input.
Right. So you know, we do always have to keep assessing where the money's going. And just as an aside, it's been very interesting over the last 6 or 8 months, all the discussion about passive investing versus active.
Right.
At exactly the time when correlations have started to fall, meaning certain sectors really doing well, certain sectors doing poorly, and you can actually add a lot of value by picking the right companies and themes. At this point, I think that Walgreens, within the group, is the one to own. I mean, certainly it's behaving way better than CVS, and they've done a really good job, you know, rationalizing this business. But in the short run, it probably doesn't have the same leverage as some of the other sectors. And so, look, it's got a 1.8% dividend that should continue to grow. If the stock can trade north of about $86, technically it would be more attractive, but it's not at the epicenter of the buying right now. This is the type of company that would be more likely bought in a more defensive environment. And clearly, you know, we were there early this year, right? The world was much more defensive. I just think in the near term, you're unlikely to see a lot of new money going into this space. You're likely to see this type of thing, again, be more of a source of cash. It's a great company. You're not going to get hurt in it, but it just might not participate to the same degree.
Okay, let's take another caller right now. Lauren in Victoria, go ahead.
Yes, good evening. Thanks very much for answering my call. I recently went with Royal Trust Online Banking, and I'm purchasing some bank stocks, but I've recently bought some Alaris and also some Ritchie Brothers auctions. I'd like you to fill me in on the prospects with those two stocks. Okay. Thank you very much.
So
Have a nice evening.
So, Lauren, I have to be honest, I haven't looked at Alaris in a long time, so I'm not going to comment on that. Ritchie Brothers, you know, has been performing like a champ. In Western Canada, of course, there's been quite a lot of equipment auctioned off over the last couple of years. But the stock is performing well. I would own the stock. We don't own it currently. It's run up a lot, so it could certainly check back. But there's no reason not to be interested in this company right now.
Okay, let's take another caller right now. Gordon in Burnaby, BC. Go ahead.
Hello.
Hi.
Thanks for taking my call. I just phoned to ask about Shaw, SJRB, long-term hold.
Okay. So Gordon, given a choice between cable companies and telcos, and Shaw's a little of both, I would lean more toward the cable companies. But even then, again, this is not one of those sectors that is really participating in this market. I would really encourage people to take a hard look at the financial sector, right? A lot of people own these companies because they're relatively predictable. The financials are relatively predictable, but they will have higher dividend growth going forward. And I would encourage them to look at the U.S. financials because they'll benefit from deregulation. So we owned both TELUS and BCE coming into the election, and they were sold almost immediately. Just because as rates are going higher, it is a challenge to these companies because they do get hurt by higher rates.
Okay, let's take a short break. We're going to be back with David Burrows. He's President and Chief Investment Strategist of Barometer Capital Management, taking your calls and questions on North American large cap companies. You can call us toll free at 1-855-326-6266.